Understanding monetary policy, an in-depth exploration. Monetary policy is a critical component of a nation's economic framework, employed by central banks to control the money supply, influence interest rates, and promote overall economic stability. Its significance cannot be overstated, as it directly impacts employment levels, inflation rates, and economic growth. This article delves into various facets of monetary policy, including its types, strategies, objectives, tools, and differentiation from fiscal policy. What is monetary policy? Monetary policy refers to the actions and strategies employed by a nation's central bank to manage the economy's money supply and interest rates. The primary aim is to influence macroeconomic conditions, achieve stable prices, promote economic growth, and maintain low unemployment levels. In the United States, the Federal Reserve, commonly known as the Fed, implements monetary policy based on a dual mandate: maximizing employment and stabilizing prices. Key takeaways. Monetary policy involves actions to regulate the money supply and achieve economic growth. Strategies include interest rate adjustments and changes in bank reserve requirements. Monetary policies can be categorized as expansionary or contractionary. The Federal Reserve utilizes tools such as reserve requirements, the discount rate, and open market operations to manage the economy. Types of monetary policy. Monetary policies are classified mainly into two types: expansionary and contractionary, depending on the current state of the economy. Expansionary monetary policy. This approach is typically adopted during periods of economic slowdown or recession. By lowering interest rates, expansionary policy encourages borrowing and spending, leading to increased consumer demand and economic growth. This mechanism aims to reduce unemployment by stimulating business activities, thereby creating more job opportunities. Contractionary monetary policy. Conversely, contractionary monetary policy is utilized when the economy is overheating, typically characterized by high inflation rates. It involves raising interest rates and limiting the money supply, which helps curb excessive spending and stabilize prices. While contractionary measures can slow down economic growth and potentially increase unemployment in the short term, they are often necessary to maintain long-term economic stability. Goals of monetary policy. Monetary policy closely aligns with key economic indicators, primarily focusing on three main goals. 1. Controlling inflation. Contractionary policies are employed to temper inflation by reducing the amount of money in circulation, while expansionary policies may inadvertently foster inflation by increasing the money supply. 2. Reducing unemployment. Expansionary monetary policy aims to decrease unemployment rates by promoting investments and consumer spending, thereby boosting job creation. 3. Stabilizing exchange rates. Changes in the money supply can affect the value of the domestic currency in relation to foreign currencies. An increased money supply often leads to a depreciation of the domestic currency, which might boost exports but raise the cost of imports. Tools of monetary policy. Central banks utilize various tools to implement monetary policy effectively. Some of the primary instruments include open market operations, OMO. Open market operations involve the buying and selling of government securities, bonds, in the financial market. When the central bank purchases securities, it injects liquidity into the economy, effectively increasing the money supply. Conversely, selling these securities withdraws money from circulation, helping to control inflation. Interest rates. The central bank can adjust interest rates, specifically the discount rate, which is the interest rate charged to commercial banks for short-term loans from the central bank. Changes in the discount rate influence the borrowing capacity of banks, thereby affecting consumer lending rates. Reserve requirements. Reserve requirements dictate the percentage of deposits that banks must retain as reserves. Lowering reserve requirements allows banks to lend more, thus stimulating economic activity. Increasing reserve requirements, however, restricts lending and curtails growth. Monetary policy versus fiscal policy. While both monetary and fiscal policies aim to manage economic stability, they differ in execution and scope. Monetary policy, enacted by central banks, such as the Federal Reserve, and focuses on controlling money supply and interest rates. Fiscal policy, administered by the government, involving adjustments in taxation and public spending to influence economic activity. The U.S. Treasury Department implements fiscal measures to inject money into the economy. During significant economic events, such as the COVID-19 pandemic, both monetary and fiscal policies have been coordinated to address the challenges effectively. How often does monetary policy change? The Federal Open Market Committee, FOMC, meets 8 times annually to reassess and adjust the country's monetary policy. However, in times of economic crises, like the 2007-2008 financial crisis or the COVID-19 pandemic, the Fed can take emergency actions to stabilize the economy. Conclusion: monetary policy is a vital tool employed by central bankers to maintain economic stability, adjust interest rates, and influence the overall money supply. The balance between expansionary and contractionary policies is crucial to mitigating economic fluctuations. Through tools like open market operations, interest rate adjustments, and reserve requirements, central banks manage the economy's pulse, striving for a harmonious coexistence between inflation control and employment maximization. Understanding the intricate workings of monetary policy is essential for grasping the broader economic landscape.